And good morning and welcome to our Retirement Income Planning Process webinar. My name is Ryan Urban. I'm with Alpha Financial here in town. Thanks for coming this morning. It looks like we have some guests here today, so we'll go ahead and do a full introduction as well. Want to remind you, as always, everyone is on mute. So if you have dogs barking in the background or phones going off, that's going to be okay. Very briefly about us, for those of you who are new, we are Alpha Financial here, Colorado Springs, 5245 Centennial Boulevard. There is our contact information. Our website is alphafinancial123.com. You can email me with any questions on today's webinar directly at rurban@alphafinancial123.com. It's right there. That's me on the left, and our staff. When you call in, the cheery and very professional voices you hear when you call in, Diana and Shannon, and they do a great job for us. Very quickly about myself, I've been in the business for roughly 20 years, written a couple of books, The Business Owner's Guide to Money and Safer and Smarter Retirement. Let's jump in. This is about income planning, and I think that a lot of people, in a way, they kind of avoid their retirement income planning because it just seems so complicated. I think what goes on in the minds of a lot of people when they think about income planning is all kinds of charts and graphs and spreadsheets. And you might be surprised. This is what they're looking at. They think it's going to be very difficult, and it really isn't. And in fact, with patience and just a little bit of guidance, it's not too bad at all. And really, we only have 6 questions to get us quite a bit into the retirement income planning process. Now remember, and I want to make this very clear, that everyone's situation is going to be different. And, it has to be approached in that way. However, this is where a lot of the stuff is done. A lot of the work is done with just these 6 questions. The first one is, how much money do you have saved today? And we're not talking about emergency funds or money that you're going to be using anytime soon, cash laying around, anything like that. We're thinking more along the lines of money that you have specifically put away towards retirement. So that will be things like 401k plans, old 401k plans, IRAs, SEP plans, simple IRAs, whatever it is that you have. So we go ahead and we get those statements and we make a listing of exactly where you are today. Then our second question is, how much are you contributing monthly? So if you're contributing to a 401k plan, we'll just look at your pay stub and it'll be able to show us. So for example, if you over the course of a year, let's say last year, contributed $3,000 to your 401k or your IRA, well, then we're going to say you're averaging about $250 a month. Now, that may be changing, but we'll use that as our guide for your income plan. Third, are you getting any kind of employer matching? And people often forget about this, and it can be very important. If you have a 401k plan, or for example, a simple IRA plan at work, a 457, anything like that, there's a pretty good chance that your employer is also matching at least some percentage of what you're contributing. So for example, you may be contributing 8%, and it may be that your employer is contributing 4%. So you may be contributing 8 and getting 12. So that's another thing that we can see on your pay stubs. Or of course, there are plenty of ways to find that number. So we make sure we plug that here into our formula. Next, how long before you'd like to retire? And here's why this matters. If you're 30 years old, well, you're still 30 or 40 years away from retirement. And so you're going to invest differently between now and then. You're going to invest more aggressively with higher ups and downs. But normally, typically, better investing on the aggressive side means you're going to earn higher returns over time, most likely. If you're 60 and you can kind of see the light at the end of the tunnel, you're coming in for a landing, well, then you have to more than likely, and this is not, again, not for everyone, but more than likely you're investing more cautiously, more conservatively. And so what we're going to do then is the amount of return we're going to be expecting is going to drop a little bit. And I'll show you how that works here in a few. And I also understand that you may not know exactly when you're going to retire. Well, the great news here is this process may tell you I've had that happen many times when people came in and said, I don't really know when I can retire. Well, after we ran the numbers, they had a pretty good idea. And sometimes that answer is you can retire anytime you feel like it. So they walk out of here with a real bounce in their step. Next, what are your Social Security benefit estimates? Now, Social Security is really a conversation unto itself, and I will be doing a webinar specifically on Social Security. We're going to keep it simple for the purposes of this presentation, but you can go to socialsecurity.gov and you can estimate your retirement benefits at ages 62, 66, and 70. And so we have you bring those numbers in. And that's where a lot of fluctuation comes in, because, if you're waiting for Social Security, you can take it as early as 62. Your full retirement age, where you get your full benefits, is going to be between 66 and 70, and you can wait as long as until 70 years old, and it increases during that time. And so we play that game. And then, of course, there are spousal benefits. So we really massage that. We look very carefully at your Social Security numbers. And finally, are you expecting any other income in retirement? This might be something like a pension, a military pension or a job pension. You may have rental real estate. You may own a part of a business, or maybe you own a business and part of their pay to you to buy the business is going to be regular payments. So we're going to look very carefully at your other income as well. That's it. Those are the big six. So there are 2 steps to this process, and you're going to see how simple this is. And a lot of people can do this on a piece of paper. So for step 1, we're going to figure out, or at least we're going to intelligently guess your retirement income. So we have Al and Maria, and we're going to keep some of these numbers simple. They're currently 55 years old each, and they want to work until full retirement age, which is, in their case, might be 66 years and 8 months. It depends on when you were born, but we'll go over that if we sit down for this. So they're both 11 years away from retirement. Well, their current retirement savings are here. Al has about $148,000 put away in his 401k, IRA, whatever it is. Maria, just under $112,000. That's where they are today. Then their total monthly contributions. We'll say that Al, between his contributions and his employer contributions, are $620 a month, and Maria is putting away about $500 a month. Then we're going to give a projected investment return, and I mentioned this earlier, and I'll go over this very quickly again. If they were 30 and still had a long time horizon, they can handle a little more risk, a little more volatility, a little more excitement in the stock market. Well, their projected return is going to be higher, at least. And again, this is an art as much as it is a science. So if they were, let's say, 62, well, their projected return, I may make it 1% or 2%. So it really depends on the individual, because also they still, even when they retire, may want to stay aggressive depending on their financial situation. So what we're going to do in this case is just say 6%. Well, when you have those savings, those contributions, and that return, this is about what your nest egg is going to look like when it's time to retire. So Al has about $403,000 in his nest egg, and Maria has about $309,000. Well, here's the big question I get all the time. I get 2 big questions. The first one is Social Security going to be there? And my short answer to that is most likely. But the second question I get all the time is, well, how much can I take out of my nest egg in retirement and not run out of money? You've heard the term outliving your retirement money. Well, that's what we're talking about. You don't want to run out of money. Well, there is a rule of thumb, and this is not my rule of thumb or Alpha Management's rule of thumb. This is the industry rule of thumb. It's called the 4% retirement income rule. And what it says is that there are going to be ups and downs in the market when you're in retirement. So you probably, and again, this is not for everyone, but probably you're going to want to invest a little more carefully and conservatively in retirement. Well, still, you can do that and still retain a an ongoing return in average somewhere between 5 and 7%. That is possible. Well, what you do then in retirement is take out 4% first year of your retirement nest egg. Well, what you're essentially doing then is you're living off the growth and the interest. And the beautiful thing about that is that if you're earning more than you're taking out, well, your nest egg is growing. And there's a pretty good chance that either Al or Maria will predecease. One of them is more than likely going to die first. Well, what happens is that person's nest egg is like a life insurance policy. It's actually gone up. It goes right into the other spouse's account, and their income continues exactly as it was before. So that's the 4% retirement income rule. Is it required? Absolutely not. If the first thing you want to do when you retire is, and I've seen it, dip into your nest egg to buy a new boat or a new motorcycle or a new cabin, well, that's your money. But in terms of the income that we're creating out of your retirement income nest egg, we're going to use the 4% retirement income rule if we can. If it has to be more, it has to be more, and some people will be a little bit less. All right, so there you go. So for Al, it's about $13.43 per month, and for Maria, it's about $10.32 per month. So now we start adding this stuff up. We've gone online, and we've looked at their estimated Social Security incomes, and we're saying at age 66 in this case. So Al is $25.08. And Maria is $22.90. And I can tell you, I've done this hundreds of times, and people are often really surprised by how much their Social Security benefits are. So just between the two of them, they're at $4,800 a month just on Social Security. Now, there is a danger here that we're going to address in a little bit, but when they begin their retirement, that's what it's going to be. Next, turns out Maria has a pension from one of her old jobs. And what's so funny about this is first, people will often say, oh, yeah, I forgot about that. Or they'll say, it's only $758 a month. Well, that counts. That goes into your retirement income monthly. We'll say that Al had no jobs that had a pension. So Maria's income now just increased by $758 per month. We'll also say that they have a rental property or two or three, and their average net profit is about $1,000 a month. So I'll just split that between the two of them for $500 a piece. A couple of other things we're looking at here, though, is how many more years of mortgage do they have on that rental property? How many more years do they have on their regular mortgage? Because when those things are paid off, pow, you just gave yourself a huge raise. And so that's part of the income planning process as well. So there you go. We have their retirement income, we have their Social Security, we have their pension, and we have their rental property. So now we have a total projected income of $43.51 for Al and $45.80 for Maria. Okay, so far so good. So let's now bring that up here on the top right. That gives us a total gross income of $107,172 projected. And there isn't that much projection, and there's not a lot of, there's no blue sky here. We were pretty careful with our numbers. We're going to throw a curveball into this, and we're going to say that $86.79, a little over $8,000 of their income, is coming out of one of their Roth IRAs. A Roth IRA does not allow you to write off your contributions, but it does come out tax-free. So that $86.79 is going to come out of their taxable income. So now their taxable non-Roth income is $98,493. We got to pay taxes, and taxes are not going down. So I threw out 22% here between federal and state. Again, we don't know. We make our best guesses as we go. But we'll say that on that $98,000 taxable income, they're going to pay about $21,668 in total taxes. Well, if you fold your Roth IRA income back in, that gives us a net annual income in retirement first year of $85,504, or about $71.25 per month. Well, that's great. For a lot of people, they're jumping up and down for joy. But this is only half of the page here. Okay, that's your income. What about your outgo? Well, it may be that their desired budget in retirement is $5,500 per month. Well, by my calculation, they're looking pretty good. They've got $1,625 per month left over. And this is after a full budget with everything they want to do. And they've put in $500 a month to average for travel and all that good stuff. All right, so they've got $1,625 left over. They may start 529 college plans for their kids. They may improve the house. They may just put that money away for a rainy day. But I also get people who might come in with a desired budget of $8,200. Well, now what? We've got a problem here. We have to discuss this. Net income $7,125, desired budget $8,200. And I've had people say, gosh, we had a lot of money. We really thought we were going to be able to handle it. Well, that's your budget. And believe me, I've had people come in who have a budget of at least $100,000 a year that they expect to live on. Well, that's okay, but this is the time now to make the tweaks in their plan so that they can raise their income in retirement. How do you do that? Well, you increase your total monthly contributions. You work a little longer. You sell your rental property, or there are a lot of different things you can do. But this is why this is so important. This is the time to do it now. What you don't want to do is wake up the first day of your retirement and then come and see me, and then you're $1,625 in the hole. Okay, that's not going to work. So the earlier you can work on this process, the better. So that's step one of 2 steps. That is your income planning budget and your income planning estimates. So right now, if your desired budget is $5,500 and you're at $7,125, we're in good shape. Here's step 2 of our process. This is different. Al and Maria now have a few things to think about. And I told you I'd have a couple of curveballs I'd throw at you later on. But this is real life stuff here. Nothing that we're discussing here is unusual or crazy. Well, first of all, if Al dies first, Maria's monthly income is going to drop by $2,290, which is the lower Social Security benefit. Okay, she'll get to keep the higher one, but that lower one would drop. If Maria dies first, Al's income is going to drop by $3,047 because he's going to lose her Social Security and her pension. Well, what do they think of that? They may be in such a situation that it's okay, but we really do have to think about that. Also, what if one or both need long-term care? There's a 70% chance of that. And those of you who are clients know that many years ago, I was a director of a large home health care company. And I can tell you firsthand, nothing burns through wealth faster than the need for long-term care. So we have to think about that, and we will. Next, do they want to leave money to their heirs or to charity? And that's also up to the individual. I'll say, well, yeah, I'll have people who say, I absolutely want to leave money to my kids or grandkids or charity. And I have other people who say, I want to bounce my last check. I don't need to leave anything money for anybody. Well, okay, great. Now we know, but that's part of the planning process. In what direction do they think income taxes are going? Well, if you're like me, you have a pretty good idea that they're more than likely going up, and we have to think about that as well. So how can we deal with these issues? Well, you have to, first of all. Ignoring them ain't going to work. And there are a few emotions I dislike more than regret, wishing that you had done something differently in the past. You don't have to. It can be part of the planning process. Here is what I do, and literally my wife and I do. This is what we have to address these issues. It's called life insurance with living benefits. First of all, what this does, it provides a tax-free death benefit to your spouse or your heirs. Now, if you're going to be replacing income, remember the 4% rule. You have to think about, well, what is this life insurance for? I think a lot of people don't think about that. If you're only getting life insurance to pay off the house, that's fine. So now you know how much you have to get. But if you need to replace the income of a spouse who has passed away, you have to remember the 4% rule. So here's an example. If Al wants to replace Maria's $3,000 with the 4% rule, then he's going to need a death benefit from her life insurance of about $914,000. That's just the 4% rule, simple numbers. But that's how we do this. So now Al knows, well, And Maria knows that if she passes away, that life insurance is going to go tax-free to Al, and then he can invest it and his income would remain the same. But here's the great thing about living benefits. It allows you to access your policy's death benefit if you need long-term care. So for example, if you have a $1 million policy and you need long-term care, and what you need long-term care means is a doctor says you need assistance with 2 activities of daily living. That's things like eating, bathing, toileting, transferring, continence, that kind of thing. Same triggers as a long-term care policy. You can access your death benefit to pay for those while you're alive. So it's your life insurance policy, but it's a living benefit for you. So that can be very, very helpful. It also can be structured so that Al and Maria can minimize their exposure to higher income taxes in the future. The nice thing about these is they're no more expensive. There are only a few companies that offer them, but they're no more expensive than regular life insurance, and they're available in 10-year, 20-year, or 30-year term, which is the cheapest kind. Or if you prefer permanent coverage, there's essentially one it's kind of a permanent term policy, or you can do things like universal life or whole life. So that just depends on your personal situation. There's not a right or a wrong here. So what we've done in this fairly simple process is we've estimated your retirement income based on what you're doing and what you plan on doing in the future. B, we've looked at your budget so that we can balance, are you making enough money to live the way you want to live, or what tweaks need to be made? And C, we're protecting the whole thing. That's the income planning process, and that is all there is to it. It's not that tough. I appreciate your time very much. Now, here are our contact numbers. You can contact us at the office, 719-358-7116. My personal cell is 659-9190. And if you have any questions at all, just email us at rurban@alphafinancial123.com. If you go by alphafinancial123.com, it'll tell you about, we do tax preparation, tax planning. Also, you can set up an appointment online if you would like to do that. That's the income planning process. I'm Ryan with Alpha Financial. Thank you very much for joining us, and we'll talk to you soon.